Well, I'm going to the city and I'm gonna do a city show. And I know all my fans wanna learn how to make some dough. I've been cruising up and down for trades each and every night. And with my iPhone exciting, I know we're gonna get it just right. I'll get inside your mind, we'll have a real good time. We're gonna trade today, we gotta trade today. Go askSlim.
Hi, I'm Steve Miller. Call me Slim. And this is the askSlim Market Week. It's a look back at what happened in the financial markets in the past week, and a look forward at what might happen in the next week, and hopefully lots of great ideas and opportunities for you throughout this show. Well, the stock market had a little bit for everyone last week as indexes ended the week mixed to higher. The NASDAQ, again, was the best index, and you just can't put too many stocks that are tech stocks in your portfolio. That's a lot like saying you can't put too much water on a nuclear reactor. Think about that one for a second. The Russell continued to be the weakest index around as fear grew about the small cap zombie stocks out there that remain incredibly dependent on the lifeblood of the Federal Reserve. Besides the techs bolstering the stock market, China led with a huge run to the upside. It had about 8 straight days where it was moving up, and that led the U.S. market up a lot Monday morning and into Tuesday morning. The Hang Seng on Monday gained over 5%. It was a huge spike, and that brought that high for the week basically on Tuesday for U.S. stocks. China now has fully recovered that big decline from March, well, a lot like our NASDAQ has. After that, the market did chop around a little bit. There has been a huge surge in COVID-19. We're all watching that news, and the stock market took a few hits based on that news coming out. Now, we've had a day where new cases have topped 60,000 in the U.S., and the infection rate is soaring. In Miami, incredible here in Florida, Miami, the infection rate is about 26% positives. That is just mind-boggling. Florida is about 16%, South Carolina about 20%. So there are areas in this country that COVID-19 is just exploding, and that is not really affecting the stock market very much. It is affecting the jobs numbers, which are not improving as fast as they were. And when you look around the world, the report of CAPEX around the world, capital expenditures, for this year they're expected to be down an astounding 12%. So you're not getting any real growth. Of course, the only thing you have that's holding things up is central bank fairy dust. And that's the world that we're in right now, where you don't really have a good sense of the realities of values in stock markets. All you have is a good sense that the Fed is out there with other central banks lifting markets up. PPI came out also down about 2%. That's at 0.2%. That's the third month in a row of decline. And as prices fall, it's a reflection of the inability for the economies to pick up. No matter what they tell you, a V-shaped recovery is just not coming. It's just not. The biggest down move for the week came on Thursday when the Supreme Court ruled that the New York grand jury could subpoena President Trump's tax records. Well, Congress can't do it, but the New York grand jury can, and that's probably going to, if it happens, is going to expose Trump to what he doesn't want the world to see. Well, if he wanted them to see, he would have released those a long time ago. Well, you might mark your calendars, because that big decline that we saw where the S&P fell 50, 60 points quickly on the downside, July 9th, 2020, at around 9:30 a.m., I think that's the moment that investors realized that there is a big risk to asset prices as if we do get a Biden win. Of course, this is in line with our analysis. We believe that the stock market was going to move down July and August, and that it would have an overall decline of about maybe 10 or 12%. And if that perception about the election and those results persist, the stock market rebound, it's about over. And from now into the election time, it could be rockier than even our projections show. We had believed that we would get a decline into August and then another pretty good rebound in the stock market. But we think those polls are going to make a difference, and we're going to be watching how that affects the market going forward. The perception is that the stock market did incredibly well over these last 3 years, and that if we start getting higher corporate taxes and other spending policies that are likely to come in, that the stock market will not do as well. We're expecting that this intermediate top is forming, and by mid-July, the risks go up pretty significantly, and that there is likely a pretty good dip ahead of us. I'll show you that as we get into the short-term view. For the week, stocks really narrowly mixed except for the NASDAQ, which is up about 3%. Getting a little sloppier here, though, on Friday as the stock market's trying to rebound from the Thursday hit, but NASDAQ is not really able to. The bond market, the 30-year, up about 2.5 points. We have raised our targets in there, and we sent out new charts to our level 4 subscribers on the bond market. That's based on the yields having broken down from a significant level. Now the 10-year yield's trading about 59 basis points, down about 7 basis points on the week. That's a pretty strong week for the bond market, a pretty weak week for yields. And the yield, the bond markets are doing great as far as the government being able to sell a ton of paper at very, very low prices, some record prices, because people are nervous about where they're going to put their money. And of course, they can't get any money in yield from the banks. Of course, that's been fuel for the stock market, but there is a lot of demand for bonds. And we see that, and it's pushing prices up, and we have upgraded those projections in there. Gold market, it did break out over that 1800 level per our expectation. It's up about $20 on the week. Silver is the big gainer, surging about 70 cents on the week, a much greater percentage. And we'll show you also, coming up towards the end of the show, what our perception is for gold at this time. Dollar down about 0.6%, nearing our 96 target, and we believe it will remain weak. Oil just slightly down in a very, very tightening, narrow range for the stock market. So that's the look at what happened in the market this week. We have some really, really interesting things to show you as we begin to move forward. So we're going to move now into our really great educational pieces that we look at. But before we do that, I want you to remember, if you're watching this on YouTube, to subscribe. Share it with anybody who you think is interested in the markets. I know we give you some great information. And do give us a thumbs up, like this video, and activate the notifications because we put out many clips every single week. And follow us on Twitter at askSlim. If you want more information about our memberships and even a demo, you can write to Matt at askSlim.com. So now we're going to get into a little bit of a trader education piece that I want to share with you. I'm always talking about riding the impulses. That means it's about the importance of being on the right side of the big moves in the market for your best overall profitability. That goes for traders or for investors. You really need to get a good ratio of catching the bigger trades versus the size of your losing trades. We all have winners and losers, and it's important to have more winners than losers. But it might be equally or greater importance that your winners are much bigger than your losing trades or investments. So we're always looking for ways to show that to you. And I'm going to show you another way right now. Last month, I brought to you the momentum breakout bands and showed you the importance of using them. And many of you wrote to me and said that, wow, you liked it. And many of you wrote to me and said, wow, those are not on my system. So I'm not able to put up these momentum breakout bands. I'm going to show you this other way because I want to kind of get you the opportunities to improve that win-loss relationship and that's by looking at Japanese candlesticks in a little different version. This version I'm going to show you is called Heikin Ashi candles. Heikin Ashi in Japanese means average bar. Essentially what they do is they take a candlestick and they add in a 2-day moving average. So it smooths it out a ton and essentially is a reflection of trend. Now, you lose a little bit doing that. If you're an avid candlestick user like I am, you might want to use them side by side. But I really want to show you how this helps you with trend and how important that is when we look at this. What you lose is your candlestick patterns, and you also lose gaps. So those are important information. So again, you might want to use the both variations of candlesticks. I'm going to move in a chart right now for you to see, and that is a kind of a double version of candlesticks charts. You can see on the left and the right, those charts look pretty much the same. However, the one on the left is a regular candlestick chart. The one on the right is an Heikin Ashi chart. I'm going to zoom in right over here, and I'm going to look at this period right over here where the stock market had that big decline in March as it rallied up into that March period and then turned down. And now you could see the side-by-side candles in here. So there's some things in here that you'll see that don't show up, but other things do. You can see in here that it kind of looks like a pretty choppy action on the way down. And each of these candles, you don't really have a sense of trend in there. I mean, you know it's going down. There's no other indicators, but you don't really know when it's going to stop going down. Here you had a little island formation right over there. And if you look over here, that island did not form because the Heikin Ashi does not allow gaps to be seen in there. So what's valuable in here is that you see that this doesn't really reflect the trend right over there. However, this clearly reflects the trend right in here, and it's a much better observational way to get a real sense for trend in the market and for not entering on your longs too early or staying in your shorts in this case and being able to catch the big wave down. There was a minor uptick in here of a few days. You can see that right here. But then the downtrend reestablished, and it was visible. You could see that as it showed you that on these Heikin Ashi candles. You didn't really have a sense of that right over here, so that really gives you the sense of the value of using the Heikin Ashi candles, or both as a side-by-side, as I have right here, so you can get a good sense about candlestick signals and momentum signals all at the same time. I'm going to move this over and just show you the market we're in right now as the NASDAQ has been surging on the upside. And you can see in here this upside, you could see it moving up. It was pretty clear. But this shows you in here these trends that continue on the upside. The correction that you can see right in here, and then the resumption. And here's I put that arrow in there where it resumed again after giving you that those little flags. Now, the flags and things like that still work. I can put the flag right in here, as you can see, and I can put a flag right in here, and it shows up on both. You can see that, where you have those flags and your breakouts, and all that still works. But over here, you're not really that sure. Here you see trend resumptions that are really clear. So you can see as we looked at the NASDAQ, just great information using that different type of candlestick. Really, really valuable. Let's just take a look. We'll look at a commodity. We'll look at a couple stocks. We'll look at an ETF, and you'll get a sense for it just to look at this really quickly and see the value in here. Here's your light crude market. So if you look at this decline in here while the market was collapsing back in March, you can see the clear trends that it's showing you. I mean, I don't know, I love the momentum breakout bands. I love the slim ribbon. All of those things are great momentum indicators. This is a really simple one. If you don't have those and don't want to put those up and clutter your charts, it really gives you a very, very good sense for trend. Here you could see the uptrend that established right over there as the market started to go up. And instead of getting all those messy gaps going up and not understanding the market, the Heikin Ashi gives you a very, very clear look right there. And again, you could see these little flags as they show up, and those are often little corrective areas. And then when the uptrend resumes, well, then you could see the quality of that right there. So just great information when you look at that in light crude. Let's look at a couple stocks, and you'll see, let's just pick Microsoft right here, and you'll see these clear uptrends. Just look at this uptrend right here, and these little consistent waves of upward movement here that they probably lasted about 10 days, 9 to 11 days on each one of those impulses on the upside. Very clear when you look at that. Boeing, which has been a horrible stock and now is in a rebound period. I mean, let's just look right over here at this period there where it had the big break. You can see the clarity there in that downward trend. Does it get any clearer? I don't know. I mean, really valuable when you look at that. And now we're in this uptrend. We had that uptrend, as you can see, that stalled. And the Heikin-Ashi candle is really giving you strong information. One more that we'll look at right here. This is interesting because I mentioned earlier in the show that China has done so well. And what this is really good for is that in stocks that gap a lot, or symbols that are like ETFs or ADRs or things that move around a lot in gaps, this smooths it out. It gives you much better information. So if you look at this rally period, well, let's just look first at the sell-off period right here, and you could see you don't have those gaps. It smooths it out. It gives you great information. And if you look at this rally period we're in right here, you had those big upside gaps. You can see that, but trend is much clearer when you look at it with the Heikin-Ashi candles. It gives you a much better pieces of information because we're always looking for a sense of understanding the market, and this does a much better job of that for you. So didn't want to go there yet. We'll come back to the light crude in a second. So that's a look at these this great educational piece. Heikin-Ashi candlesticks, ways to ride the upward impulse or downward impulse, whatever it is, and give you a much clearer look at the market. I hope you liked that. You can always send me your comments on that, and just let me know if you found it valuable. Always want to hear that. So that is a look at our trader education piece for the week. We're going to get into our short-term view now as we look at the 5 major markets, and we're going to do this as we always do, as we look at light crude, the gold market, the dollar, the bond market, looking at the 30-year, and then the S&P 500. So let's take a look here as we switch over to the daily charts. And here is the light crude market. So for those of you that are new to our show, we are cycle analysts here. It is the core of our work. We look for the rhythms or the heartbeat of the market through repeating patterns. There are very clear repeating patterns in almost every single market. We look at about 400 symbols, 300 plus stocks, and about more than 75% of them have clear cyclical rhythms in them. And this is a look at those rhythms here as you look at the light crude market. I'll just go out a little bit further in here, and you could see the rhythm on the downside in here as these cycles stair-stepped on their way down, and then on the upside. On the bottom is the projection oscillator, which we use with the slim ribbon, which gives us the momentum signals. And you can see in here the buy signal that says the momentum is still strong. And those are locations you would either add to long positions, initiate long positions, or just simply get some comfort that the upward momentum is still staying in place in here as it has right now. Now, when you get a situation where you're in a corrective period here and here and here, and the market doesn't go down, what it tells you is the momentum, the upward directional component, is so strong it won't allow corrections, and that's when you get swamped indications right in here, where the upward directional component is swamping the corrective periods where you can't get declines. That's what you have right over here. So we expected that we would be in this corrective period right here. All we got was sideways and slightly lower action. So we always rank ourselves by the what we see in the candle what we see in the cycle patterns, what we see in momentum, where we are in support and resistance, what the rising and declining phases look like. And all of that we rate ourselves. And we're going to get about a 70-75% this whole week. Is we didn't get enough of decline in light crude, and the stock market is holding up a little bit better than we expected also. So we lose a little bit of points in there, but 70 to 75%, pretty good that we're looking at. So what are we looking at now for the light crude market? We're looking at the swamp cycles telling us that there's another up move coming. And you can see today it tried to go down and started to come back up here on Friday. We're looking for another test of these highs over here at about 41.50. There's an outside chance it could break out of the range that we've seen it in, above that 41.50, and get up here and test 43.80. So we'd rate that as maybe about a 30% probability. We'd rate getting up to this 41.50 area about a 70% probability, and a real solid, strong pattern that we're seeing here in the oil market. Some of the evidence, we have improved patterns. And they say that we're going to probably get a minor new recovery high in here at some level, and that the market still on the intermediate patterns is in big resistance that tops out around that 43.80, 44 level. So slightly new recovery high likely, and then probably rolling over into more of a corrective period out over there. That's a look at light crude. Next thing we're going to look at is the gold market, /GC. This one we were very good in, and you can see in here the gold rhythms as I blow this up. For those of you that are unfamiliar with this very messy artistic chart, what we're looking at here are dominant cycles right in here that also have minor thirds in them. There's also a bigger dominant cycle right in here in that blue dash line that bottomed right over here. So that bigger one is made up of 4 cycles. You can see that. We're now into this cycle and the second cycle right over here, and into a little corrective period. We've been looking at that and saying, well, it's probably going to try to break out, but then be a little bit sloppy, and then another period where it moves up again of some significance. We're going to look for the gold market to have about a 5 to 8 days of sloppiness in here, a little bit of a retracement before it then again moves up above that 1830 area and probably significantly higher. This area is the minor or short-term support buy zone. You can see the upward momentum there clear in that slim ribbon, and that is likely to continue to give you upward support right there. Note the buys, and there's a buy pending right over here. So this is your short-term support buy zone right in here, these green areas, and then we expect it's going to move up again. So some of the evidence is that momentum strong. You add that to intermediate upward strong momentum. And that it's trading in a range, and we expect a breakout that will come again. That would probably be after some test of these areas down over here, slightly under 1800. I just got under 1800 right now. I wrote that earlier. It wasn't there. Down over here, this is about 1792. This is about 1780. So that's about the areas that we think it'll come down. This is about 4 or 5 days in here. It might run a little longer, and then beginning to move up again. So when we point there, it's to this low. It's not exact. The principle of variance really puts it at 3 bars either side of it. And we've seen that pretty consistently in all markets, that you can't just pinpoint the day. You want to pinpoint a time range for these areas, and then begin to nibble when you get into them, because the probability is high that this will be moving up to the upside again. That's a look at the gold market. We did an in-depth gold analysis in FutureSpeak, and we put that out for the public this week because we wanted to just see the depth of the analysis we do when we look at other momentum conditions, and we also look at the 2-hour charts. The intraday charts, 2-hour charts are phenomenal. They give you so much information, and you could see that also. We'll put that one up on YouTube for you. So we show you these things because we want you to see the quality of the work we do, and we want you to be a subscriber. So that's a look at the gold market. Next thing we'll look at is the dollar. We've been bearish in there and correct. And it helps when you're, bearish in the dollar, bullish in gold, and all of those things are inversely correlated and acting properly. That really helps with the analysis. So we were looking for the dollar to slide down further down in here. Thought we would get down close to 96. It did that. It got down pretty close, and then bounced a little bit. We're looking for a couple more days, a little bit of early weakness right in here. And I think over the next couple of weeks, we'll be looking for a minor dip into early part of next week, and then you could see a rally in here. So we talked about gold being weak, for the next maybe a week. Well, maybe this is only a week-long rally right in here, and then it begins to turn down again. There's your resistances. We would expect that the dollar would be able to, would first test this area back here around 96 or 96 and a quarter, and then begin to have that modest upward rally. We're going to be looking for 97 to 97.80, and that would be 97. What is this right here? Sorry. This right over there is 97.80. Okay, so the top of this resistance is 97 and a quarter. So this rally we expect to get up into this area right over here somewhere, and then begin the next pretty big impulse on the downside, which should be pretty helpful to gold. Some of the evidence has remained the same. Momentum negative, momentum on the intermediate negative. The big top that formed in a giant diamond just keeps telling us to expect rallies into resistances, and they will continue to sell off. So pretty good look at a very consistent cyclical pattern in there. If I blow it out, you could see all of those cycles, how they have formed. And the rhythms of the market are just so important to understand, and how they act in each of these support and resistance zones, and the effect that momentum puts on them. So it's all, a whole big total picture that we bring to you so that you can do the best you could possibly do. Last thing we're going to look at before I get into the stock market is ZB/ZB. You could see beautiful cyclical harmonics, as we call it. Cycles are like music. You have this big dominant cycle here, and it's made up of minor thirds. That ghost cycle you see right there is an older cycle that we left in there because we want to see if it's still affecting the market. It's out of phase, as we call it. But you can see it kind of comes down perfectly right in here. Also, there are minor thirds. You can see that. So this is the first minor third, the second one, and the third one. The third one, when it lines up with the big one, gives you the bigger decline, and that's what we got right there. So where are we right now? We are in the second minor third, and it blasted up over there and then started to come off as we got that negative PPI number. And the stock market was weak early on, but then it started to come down, and it's rejecting that area up there. Our upward target was around 80, 180 or higher, and it got well through that. And now you can see it's establishing a little bit of a high range right over there. We'll expect that maybe that 181.5 is the highest we'll see. We're going to look for a little choppy correction over here over the next couple of weeks, as you can see, and this is a buy zone, as we think it's going to explode back up. And for our members, we have sent out the new chart grid, which has the upgrades in it on, and of course the updates on all of the charts in that whole suite of charts that we send out on each of the futures. So the ZBs look to us great, momentum strong. Some of the evidence says intermediate pattern strong and up, and momentum up in all time frames, and that just says you continue to buy the dips. We'll look for a pullback into maybe that 170. This level right here is about 179.07. This one, the bottom, is about 178 3/4. So that's kind of the area over this next week and a half or so, maybe 2 weeks, before it then does start to move to the upside again. That could be some indication of stock's last hurrah. In other words, right over here, as the bond market pulls back, that's probably the area that the stock market top is going to come, because these are also inversely correlated, though the correlations have not held up as well. And in my history, going back to when I was trading on the floor in the 70s and 80s, the stock market was positively correlated to the bond market. So in other words, bond market went up, stocks went up. As the bond market went down, yields are then going up, and the stock market would go down. So we're in a period for quite a while of a panicky situation where the Fed is in control or trying to be, and the inverse correlation is really as what has held up in here. So that is a look at the bond market, and we're going to move over pretty soon and show you the stock market. So this is the short-term view of the 5 major markets. One couple little announcements in here. Our popular services preview, which we've been running for the last few weeks, ends today, Friday, July 10th. Big thanks to all of you that enjoyed it so much, and for all the great comments and emails that we've gotten from you. And so many of you now, I know, are extending and becoming full members. Yeah, for those of you that are not, and those of you that haven't experienced, we don't want you to miss a single day of our great content. So write to Matt at askSlim.com. He's going to be offering 3-month specials in order for you to continue to keep enjoying all of that depth of the great content that we put out there. There was absolutely so much. So with us, when things, we move from one thing to the next because there's only one thing that we want, and that is at askSlim, our team's greatest desire is for you to be the most successful trader or investor possible. Your success is our success, and we want you please to consider our workshops. We have 2 recorded workshops out there. One of them is the cycle analysis workshop. It's 20 video modules. Took me over 2 years to write, 6 months to produce. It's an amazing way for you to learn about the style of analysis that I do. What I really want to show you right now, though, is the other workshop, and that is the 5 essential building blocks to successful trading. Now, many of you know that I also have coached many traders over the years, and I don't take many clients right now because I'm so busy. However, my coaching curriculum really follows the curriculum of this workshop. It is amazing how much you will learn about yourself. There is a psychological overlay to this in learning about how the personal aspects of yourself affect so much of what you do in trading. There are the 5 building blocks, and this will take you about a few hours to watch at the most. And then there's homework and stuff that you want to do and processes, and you're going to be amazed at how strong of a workshop this is for you, for your own self-realizations and to come to a place of your self-actualization. It's not your everyday how-to trader workshop. I don't guarantee any winning systems. That's not what it's about. It's all about you, understanding you. 5 building blocks are to define a healthy role for trading in your life, build emotional fitness and control your reactions. That is such an important aspect of our trading. Matching up your style and method with your personality. In other words, how do you engage in the markets, and what tools do you use to do that, and how does it really fit who you are? And then adopt 6 key areas of discipline and design your own unique plan and winning formula. It's really about understanding the numbers and how you get to where you want to get at the success level that you want to have. This is one unbelievable, amazing workshop. It is so valuable, and what I want you to do is to go to askSlim.com and take a look at the workshop page, and you can get a little more information about this that we have in there. It's under $300. You're just not going to be able to get anything like this anywhere else. It comes from my 46-year career as a trader and over 25 years as a certified personal growth facilitator and also in emotional intelligence. So I combine it all and bring you this unbelievable workshop. It is such an unbelievable, great, value to you to make that kind of investment. Please do consider it. Go to our workshop pages and take a look at what we have there. So that's it. That's my promo to you. And again, thanks to all the people out there that take a look at these workshops. Incredibly valuable. All right, so now we're going to get to the short-term view for the stock market. We looked at the SPX here as kind of a representative of the stock market as a whole, and then you can just extrapolate by other strengths and weaknesses. In future speak, we do bring all of the indexes, the S&P 500, the NASDAQ, and the Russell in multiple time frames with cycle analysis. So we do show that in FutureSpeak on Wednesdays, which is, of course, a member video. So let's take a look as we switch over. We'll leave the bond market here and go to the S&P 500. So here are your unbelievably clear cycle patterns that are in here. We'll go back to this top right over here. You can see the cycles right in here as they made their lows right at this point. That low was a little bit short of time duration at 16 days. And then they started to move out in here to lengths that were longer. A more traditional length in the stock market has been around 19 days. Right now, these cycle brackets are set at about 20 days and the minor cycle at about 10 days. Minor cycles are very clear on these charts right now. Sometimes they're not. When you get a big, strong upward directional component, as you see right over here, the minor cycle here did not bring you anything but a one-day dip. That shows a lot of strength. When you get that, and the clarity in these are perfect. Here's your minor cycle low right over here, and the depth of this really had me believing that the market was going to be weaker than it was. Usually when you come down and test the 78.6, you don't get back up to the new high. It's just a very low probability. Now you could see what's going on is during this corrective period right over here, where we expected the market to be falling down into the 30, it was 30.65 down to maybe about 30.80 something right over here. It can't even tick down. So we're getting a swamping going on right over here. The upward directional power is keeping the correction from coming. There's a rotation going on even now as the NASDAQ is a little sloppy today. With Apple down on the day, they're buying other things, and the Dow is getting pushed up. So that's all rotational. That is positive as it uses up this time. And that says to us that what we're really looking at is that an early dip is likely to come. This is probably going to dip into Monday, maybe Tuesday right over here. That would be a little bit long, but you haven't really gotten anything yet here. And it's super strong. So like our target has been down, our revised upward target has been down around here about 30.90-ish or so, and it barely could get down there. It couldn't hold the dip down to about 31.17 here on Thursday. And now it's just today gaining a little bit of ground back. It's running out of time, and the likelihood is that you'll get some kind of a late, couple days. You could see what it did right over here the last days. You could see what it did right over here. That's the highest probability that you'll get a dip and then it'll come back up. This period over here we believe is going to be the high of the recovery, and that we're going to get into an intermediate correction after that. Our target has been that there will be a loss of some 10-12% on the downside between the peak that's made over here and sometime in August. There's no reason for us to change that. Nothing has changed. The only thing that's happening is that there's been a little lengthening in the patterns, and that has pushed out our expected low from maybe early August into mid-August, and that's perfectly normal, perfectly fine. So we're going to say that this is strong still. Early dip, then another up move that we're expecting that should high probability that it will take out this level that the high that we made right over there. That high was 31.84. It's not that far from it right now, but we get the dip, it should get back up there, and then the risks really start to pick out over here. We think this is the last hurrah in line with that dip that we showed in the bond market that we think is coming also. So when all of this happens, and it all lines up on the downside, there will be a significant tone change. We don't know whether or not the effect of the polls in the market is going to be the factor in it, but we're going to see something is very likely to flip the switch and the sellers come in. It's just a very, very high probability as we get into these multiple time frames that are showing for corrective processes to be in here. So we think that not much more time on the upside. Last hurrah, intermediate patterns are topping. Some of the evidence says that late July into mid-August has a significantly increase of risk on the downside. And we're going to hold to that because it is the highest probability. That is a look at the short-term view for the stock market. I hope that there was just incredibly great information for you in everything that we have shared. Again, your success is our success, and all we want to do is make you the best trader that you can be by sharing our experience, our analysis, our unbelievably broad content that we have on the educational side. 500 videos that we have for our level 2, 3, and 4 members. Become a member, support us, because then you are supporting everybody else in this trading world. I want you to be so careful. It is so crazy out there. And I'm always wishing you great trading.
Well, I'm going to the city and I'm gonna do a city show. And I know all my fans wanna learn how to make some dough. I've been